Well, where do you start after a day like that? Holy smokes. We were expecting some downside volatility, but that's just a little crazy. Today was clearly a bloodbath on Wall Street across the board. 17th largest drop in the history of our country, the largest since 2008. And all that being said, just a quick reminder so that you're not worried, we have not been participating in any of this madness. In fact, the vast majority of our portfolios that we're privileged to manage for you are pretty much close to, if not already back to the February 19th highs. And much of that came on the heels of the decision to sell everything on February the 25th and use those proceeds to purchase 7 to 10-year treasuries through an exchange traded fund symbol IEF, which I'll show you in a minute. We did decide to sell that today, and the reason why we sold it today primarily was because as a treasury, it was starting to look a little like a tech stock, and that's not normal in terms of price movement. And so when you get something that doesn't look normal, chances are it's not, and in most cases it probably won't stay that way. So you choose to capture gains when you can, making roughly 5-6% on a treasury over roughly a week and a half or so is okay. We'll take that. So right now we are literally 100% in cash, and we will wait until we get some confirmation before we choose to re-enter into any market, either stock or bond. The investment grade bond market is not faring very well either, and much of it is likely due to the perceived risks that are out there with regards to what's happening in the oil market. And if you didn't see the news today, basically the Saudis, by way of OPEC, came out and decided to start a price war with Russia in hopes to hurt them. And so therefore the price of oil dropped by 25-30%. And that's a lot. Those kinds of events oftentimes result in a hedge fund or two that blow up. Probably in another several days, if not weeks, we may hear of exactly that kind of a thing happening. I don't know that it'll take that long. But when you get a hedge fund, a fairly sizable one that vaporizes, it causes capital dislocations. Most of the time, they have a lot of leverage or margin, and when they go down, then all that margin has to somehow find a way to get paid off and or eliminated, and so it's a big mess. It's a problem. Some people have been asking me what my biggest concern is right now. And right now, my biggest concern is exactly what's happening in the oil market. And that's not to say that oil doesn't rebound. At some point, it obviously will. I mean, the benefits economically of cheap energy is obvious. It helps growth, it helps productivity, it helps all sorts of things. And eventually, that likely will be very beneficial to our economy. But right now, what we're concerned about is the blowback that occurs when you get that swift of a drop and that magnitude of a drop, specifically in lower graded or junk rated types of debt. I'm going to share a slide with you in a little bit that shows some of the debt load that has accumulated since 2008. We've gone from roughly 2 trillion in debt to about 7 corporate. So there's clearly a corporate debt bubble, I guess, to some extent. And the question becomes whether or not an event like this could cause it to start to unwind. And it's possible. When you get this kind of a movement, and I'm going to show you some pictures of some stocks in the energy sphere that are just incredible in terms of the movements that they've had, it would not surprise me if a whole host of lower rated, lower priced energy companies go out of business. And if that happens, many of them are highly levered. They've got a lot of debt. That debt then gets eliminated, and when that happens, obviously that hurts those who have issued that debt. And so the question becomes, how does that play out? So the answer is nobody knows. But what we do know is that you don't catch a falling knife, and you attempt to stay away from these kinds of environments as best as you can and wait for an institutional volume event, like an upside day, like we've talked about so much in the past, a breadth thrust or two, a breakaway momentum that we've talked about a number of times, including on my radio show. So these are the kinds of events that we're going to be looking for before we choose to enter in. What I can say is this. The deeper this goes, the more painful it gets for those in the investment markets, individual stocks, equities, passive investments, the S&P 500, you name it, right? The worse it gets for the equity investors, the better the recovery will be. The easier a breakaway momentum will likely occur, very similar to what happened in December of 2018. And when those things happen, because they're fairly rare, it is a huge indicator that good gains are not far away in terms of investing, so in equities, that is. So let me just share just a few things with you on my screens here. First thing I'm going to share with you are just some of these pictures of the energy sector that I've been talking about. This is a small energy company, and I have to look at these on a monthly basis because the price moves are just unprecedented. Here's a company that just hit an all-time low today. I'm not so sure that they're going to survive. Apache Corp, which many people have heard of, is now down to prices that we haven't seen since 2000. Chevron Corporation, you can tell where this is. It's clearly headed to probably the 15 lows, and if that breaks, probably the 08 lows. ExxonMobil, this thing is looking at prices that it hasn't seen probably since 02, based on it having broken this level of support up here. Here's Halliburton. Halliburton and Schlumberger are two of the most world-renowned oil services companies on the planet, and it looks to me that I just wouldn't be surprised to see it hit levels of 02. And if it gets down to these levels of 02, you're looking at a stock that's trading at $4 a share. Same thing for Schlumberger, since I mentioned them a moment ago. You know, you're looking at a company whose price has not been seen since 2000, and it's, you know, right at that level. So, you know, could some of these companies be a great buy? Yeah, it's highly possible. If you want to take a shot at some potential high flyers, just know that you're in an environment right now that has high degrees of volatility. Price wars are never usually very good. The oil market is very hard to trade, and picking up some of these shares at these levels may be the best thing to do ever, but it's, I think, going to carry with it a fairly large amount of risk. Ordinarily, what you want to do instead of bottom fishing is buy that which has gone down the least. That's the idea. And right now, actually, the best relative strength happens to be in tech, specifically speaking, the NASDAQ 100. So let me just share that with you real quick. So here is a picture of the ETF that follows the NASDAQ 100. And as you can see, it's just still barely above the breakout levels from September of 18, and then of course the bump up that it had in August, September of 19. So the fact that it's staying above these levels right here are very, very positive. The negative is that it broke through its 61.8% Fibonacci retracement level. You've heard me talk about Fibonacci's before. And, well, when that happens, it has a tendency to come down and test this 100% level, which it may. If it does, it would coincide with the bottom trend line from 2009. So, you know, you have to keep an open mind to a lot of outcomes, and it is highly possible that that could happen. On a negative side, when we start looking at some of the weaknesses that are out there, the S&P 500 today came down and stopped right at that 61.8% Fibonacci level, which does also coincide with this trend line, which is all the way from 2009. Worse, though, is the Dow Jones Industrial Average, and what you can see there is it sliced through its 61.8% retracement level. It sliced through its 2009 trend line, and frankly, the way the Dow looks right now, it just wouldn't surprise me if it tests the 2018 lows before it's all done. Might not be tomorrow, might not be next week or anything like that, but it just wouldn't surprise me if something like that took place. So, big names that typically house in the Dow are clearly showing some of their weakness right now, and we just have to be cognizant of the fact that that's the case. Transports are equally looking terrible. You can see today that it closed way down here, and that is below the 2018 lows. And in fact, right now it's probably going to find itself, if I had to guess, come down to that 2016 level and test that. So one day at a time. I commented that we sold IEF today. The reason being is because interest rates have just gotten crazy. So let me just show you the 10-year Treasury yield real quick. So this is a picture of the day-by-day yield that takes place in the Treasury Index. And you can see that it is literally a historic move. Typically speaking, and I mentioned this on a video a couple of days ago, that you get something in a trend that then consolidates. Whenever it decides to re-enter its trend, it usually resolves itself in the direction of the previous trend. And well, boy, did it ever. This is just astounding. It is, the bond market is telling all sorts of things right now, most of which just screaming of anticipated economic weakness. Will that happen? It's hard to say. We do know that GDP has slowly been declining and getting weaker. I'm guessing that the effect of what's taken place in the quarantining process on a global scale of the coronavirus scenario, even though the typical flu has killed way more people this year. And I said to somebody today, the fear of the coronavirus is going to be way worse than the coronavirus itself, because the impact of it is creating an environment and a culture of cancel. I talked about that on my radio show this past week, but this culture of cancel just simply means that companies are canceling everything. They're canceling conferences, they're canceling travel, they're canceling everything. That has a serious economic impact. So the fear of it is going to create a behavior change. And that behavior change is still a little bit early to identify how it's going to play out, but it wouldn't surprise me over the next few weeks to start seeing companies downgrading their earnings for the next quarter. And when they start downgrading their earnings for the next quarter, that may have an impact on how their overall stocks perform too. So at any rate, because interest rates have moved down so hard, so fast, and because the result of that has been bond prices moving up so hard, so fast, we sold out of this. And if you look at this volume down here, so ordinarily the exchange traded fund IEF trades about 4 or so million shares a day. This thing traded 170 million shares today, and it closed at the low of the day. So we sold out of this thing, and I think if I had to guess, we're going to see it mean revert back down into this range. And so we've made 5, 6, 6.5% on this exchange traded fund during the time that we owned it, and this is where the proceeds from our equity sales on February the 25th went into. I just didn't want to lose those gains. I wanted to hold on to them. So as I said before, typically when something goes up too much, or if it goes parabolic, which that is a parabolic move, it doesn't correct sideways. It usually corrects by going straight down, which is what happened in the equity market too. So that being said, what are some of the encouraging things? Well, some of the encouraging things that I want to share with you are the following. Let me just open this up for you. So if you look at this, these are instances where the S&P 500 had an opening gap down of 5% or more. And there have been 3 instances, 4 including today. One was the terrorist attacks of 2011. One was Greenspan's credit tsunami comments that he made back in the great financial crisis environment of roughly October 2008. The flash crash that occurred back in 15, and then today. The 2 biggest things that I want you to identify is that these 2 environments were already in bear markets. These were not. And you can see that, yes, this area got tested again, but it didn't go deeper. Is that going to happen this time? It's highly possible. I would have expected to see bears a little bit higher. Now this is Saturday's chart, so this number here is probably going to step up a fair amount, and this number here is going to step down a fair amount. We like to see them cross over like in here before we get a good bottom. And so this 2015-2016 look is what we'd be looking for here. But the fact that we got all this white space just makes me a little bit uncomfortable that maybe the bottom isn't fully in yet. Fear and greed, we hit a very low level of 3 today. I printed this when it was at 4. That's low. We haven't seen these levels since the sell-off of 2018. On a positive note, 30-year bond futures, when they breach the 4% level or get close to the 4% level, oftentimes it marks a bottom in the equity market. So here, October of 82, the 87 crash, the bottom of 2009, and then today all coincided with these 30-year bond futures pricing themselves on the upside by quite a bit. And so, does that mean we're going to get a bottom in the equity market? Well, it's too early to tell, but these are some good signs. If we look at what has taken place every single time the market sold off like this. So today was the 10th Monday that the market dropped 5% or more since we started with a 5-day trading week since 1952. So if we don't rally at least 2.2% tomorrow, Tuesday, it'll be the first time ever. And these are the next day rallies that took place after a massive one-day drop, ever going all the way back into the 1952 range. So could it be turnaround Tuesday? Yeah, maybe. We'll see. This is just a quick picture of what today looked like in picture format. You can see pretty much everything across the board was down, and that's true when we start to look at the internal numbers. The New York Stock Exchange traded almost 8.5 billion shares today, which is the most volume we've had in a really long time. You can see I track the New York Stock Exchange data daily. And today was what we call a 97% downside day, very heavy volume. 2,973 issues were declining. So roughly 3,000 issues trade on the New York Stock Exchange on a day-by-day basis, and over half of them hit new lows today, which is just absolutely tremendous. So again, this is a picture of what that whole thing looks like, and you can see there were very few green. Edison, Dollar General, AutoZone. I guess everybody figures they're going to have to be fixing their own car for a while. I don't know. This is the chart I alluded to a little bit earlier about corporate debt. You can see that since 2008, we've gone from roughly $2 trillion of total corporate debt from AAA rated all the way down into this serious junk level. And we're up over $7 trillion right now. And what I want to point out is the fact it's the lower graded debt, this BA, B, and CAA type tranches that have really escalated. And it's that sort of stuff that I have a tendency to think is probably housed in the energy market, or a good portion of it. And if those companies go kapoof, if they're vaporized after today's oil move, which can happen, then that debt's going to have some problems. So, at any rate, wanted to share that with you as well. So, it's not the end of the world. I don't want anyone to think that this is by any means the end of the world. It's not. We've not participated in it by God's grace. We're going to continue to be vigilant in what we're doing. We're not going to catch a falling knife. We're going to wait for an institutional volume event, which again, just as a reminder, is a 90% upside day or 2 back-to-back 80% upside days. And if we get that, then presuming along with a couple of other elements, we'll probably start to re-enter the equity market on a tiptoe kind of basis. These panic selling environments oftentimes are tested. Sometimes not right away, but in most cases 3 to 4 days after they happen. So what's that mean? That puts us somewhere into Wednesday, Thursday of this week before they get tested. Now, if we get a 95, 96% upside day tomorrow, like what we got on December the 26th, then we're probably off to the races again, just like we were then. The economy's not in recession yet, or at least it's not being shown to be in recession according to the government data, for whatever that's worth for you. And so in many instances, V-bottoms can happen out of this, but there is a lot of technical damage that's taken place over the last 3-4 days. If I had to guess, any bounces we get are not likely to be institutional upside events. So if you happen to be sitting on individual investment money away from our firm that we're not managing for you, and you're nervous about whether or not you should hold it, what I would say is that, first of all, reach out to me and I can share with you some areas that you can consider looking at for supply and demand levels. If you happen to have a 401k away from us that we don't manage and you chose to ride it out, or you're still in, don't sell into this panic. I do think we get a bounce, and the bounce might be fairly violent on the upside, which depending upon the volume, you could either use to sell into or hold on to and wait for that recovery. But this is not a time to just ignore or put your head in the sand, so to speak. These are the kinds of environments that can get silly quick if today wasn't silly enough. So at any rate, Tomorrow will come, and we'll continue to be vigilant and watch what the data gives us. If you have any questions, if you need to chat or talk about anything in any detail, by all means, please reach out to me. Direct line 608-354-1977. Email chris@careformywealth.com, and I'm happy to help you in any way that I can. And I hope you have a peaceful night. I apologize for the length of tonight's video, but it's a little bit of an extraordinary type of an environment, and just wanted to try and share some peaceful things with you. So on that note, I do hope you have a peaceful night. See ya.